Hello, my name is Elena Rodriguez. I'm the president of an import-export company based in New York City. For the past 15 years, I've been working in international trade, not just negotiating deals, but managing the financial side of those transactions, making sure that when goods move across borders, the money moves safely too. Today, I don't want to give you a traditional lecture. I want to tell you a story. One shipment of handmade rugs, imported from India into the United States. But more importantly, I want to show you everything that had to happen behind the scenes for that transaction to succeed. Because when students first learn international finance, it often feels clean and structured. But in reality, it's not clean. It's not simple. It's layered. It involves multiple institutions, multiple risks, and multiple points where things can go wrong. And at the center of it all is a very simple problem. How do two businesses in different countries trust each other enough to complete a transaction? That's the question we had to solve. Because when this deal started, the exporter in India didn't know me, and I didn't know him. No shared legal system, no shared enforcement mechanism, just a potential opportunity and a lot of uncertainty. So in this story, I'm going to walk you through how the deal started, how we structured the payment, how banks became involved, how goods physically moved across the world, and how financing made the entire transaction possible. By the end, you won't just understand international trade finance, you'll see how it actually works in practice. It started in Jaipur. If you've never been there, Jaipur is one of the most important centers in the world for handmade textiles and rugs. I was attending an international trade exhibition, large halls filled with exporters, buyers, agents, thousands of conversations happening at the same time. Everyone was there for one reason: to find opportunity. That's where I met Rajiv. His rugs were different. The detail, the texture, the colors, you could immediately tell these were not mass-produced items. These were handcrafted, carefully made, and designed for a higher-end market. We started with a simple conversation. Where are you from? How long have you been in business? Who are your current buyers? Then we moved into something more serious: pricing, volumes, shipping timelines. I told him about my market in the United States: boutique retailers, interior designers, customers willing to pay for quality and authenticity. Then he said something I still remember. I don't want to be the cheapest. I want to be trusted. That told me everything I needed to know about how he did business. So we began discussing our first transaction. A shipment of rugs. Not too large, but large enough to matter. Enough to test the relationship. But here's the reality. At that moment, despite the conversation, despite the handshake, there was still no trust. And that's not personal, that's structural. Because in international trade, trust is not built on conversation. It's built on systems. And before we could move forward, we had to solve one fundamental problem. How do we structure this deal so that both of us are protected? Standing there in Jaipur, Rajiv and I had a clear opportunity. He had the product, I had the market, but neither of us had something much more important: certainty. From my perspective, the risk was very clear. If I sent him the money up front, what guarantee did I have that he would actually ship the rugs? If something went wrong, recovering that money would be extremely difficult. Now, look at it from his side. If he produced the rugs, packed them, and shipped them across the ocean, what guarantee did he have that I would pay? Once those goods left India, he would lose control. He was worried about non-payment. I was worried about non-delivery. And this is one of the most important realities in international business. It's not just about buying and selling. It's about managing risk between parties who operate under completely different systems. Even if both sides are honest, the structure itself creates uncertainty. How do you remove that uncertainty? How do you create a system where neither side has to take on unacceptable risk? Because without that system, this deal doesn't happen. And that's exactly why international trade finance exists. Not to make things more complicated, but to make transactions possible. What Rajiv and I needed was a mechanism that would guarantee payment to him, but only if he fulfilled the contract, and protect me by ensuring I only paid when the goods were properly shipped. And that's where the banks enter the picture. Because in international trade, trust is not built between buyer and seller. It is built through financial institutions. And in our case, the solution was something very specific, a letter of credit. So we agreed to use a letter of credit. When I returned to New York, the first thing I did was schedule a meeting with my bank. I explained the deal. I'm importing handmade rugs from India. I've identified the supplier. We've agreed on pricing and quantity, but we need a secure payment structure. They asked for the key details. Who is the exporter? What is the shipment value? What are the delivery terms? What documents will be required? Then they evaluated me, my financial statements, my company's track record, my ability to pay. Because when a bank issues a letter of credit, they are not just facilitating a transaction. They are putting their reputation and their balance sheet behind that payment. This was an at-site letter of credit. It means that the exporter would be paid as soon as the required documents were presented and verified. Not weeks later, not months later, immediately. Now here's where the transformation happens. Before the letter of credit, Rajiv was relying on me. After the letter of credit, he was relying on my bank. So my bank issued the letter of credit. Then it was transmitted to Rajiv's bank in India. They confirmed that the terms were clear and achievable. And then they notified Rajiv. He now had a payment guarantee from a recognized financial institution. And this is the key idea. A letter of credit shifts the risk away from the exporter and importer and places it into a structured system managed by banks. And that system is what makes international trade possible at scale. Because now, for the first time in this transaction, both sides were protected, and that meant we could move forward. Now, let's shift to Rajiv's side of the transaction. Because even though the letter of credit solved the trust problem, it did not solve the cash flow problem. Rajiv still had to produce the rugs. Production happens before payment. He needed to pay the artisans who would weave the rugs, purchase raw materials, cover operational expenses during the production period. It required weeks of work and a meaningful amount of capital. But remember, he would only get paid after shipment. So the question became, how does the exporter finance production before the goods are shipped? This is where pre-shipment financing comes in. Rajiv took the letter of credit to his bank, and this is very important. The letter of credit is not just a payment mechanism, it is also a financing tool. His bank confirmed that it was issued by a credible international bank, and based on that, they were willing to lend. Because from the bank's perspective, this was no longer a risky, uncertain transaction. There was now a structured, bank-backed payment guarantee. So Rajiv received working capital financing. That allowed him to begin production. In some cases, exporters also work with institutions like export-import banks. So between his commercial bank and potential EXIM support, Rajiv was able to secure the funds he needed. And that's when production began. Workshops became active. Artisans started weaving. Materials were sourced and prepared. And this is a critical stage in international trade, because everything is still at risk. The goods don't exist yet. The shipment hasn't happened. Payment hasn't been made. But financing bridges that gap. It allows production to take place before revenue is realized. And without that financing, many international transactions would never even begin. Once Rajiv secured financing, everything moved from planning to execution. Production began. These were not factory-made rugs rolling off an automated line. They were handcrafted, which means time, coordination, and quality control all mattered. Each rug went through multiple stages: design alignment, material preparation, weaving, finishing, inspection. Weeks passed, and during that time, both of us stayed in constant communication, because even though the financial structure was in place, the transaction still depended on execution. At the same time, we began coordinating with a logistics company. Now, this is another key player in international trade, because producing the goods is only half the process. The other half is moving them across the world. The logistics company handled several critical responsibilities. First, packaging. The rugs had to be protected from moisture, damage, and handling during transit. Second, inland transportation. They arranged for the rugs to be moved from the production site to the port. Third, export preparation. This includes documentation, labeling, and compliance with export regulations. Fourth, cargo booking. They secured space on a vessel that would carry the goods from India to the United States. And in international trade finance, documents matter just as much as goods. Every detail must match the requirements in the letter of credit. Descriptions, quantities, dates, shipment terms. If something is inconsistent, it can delay or even block payment. So while the rugs were being prepared physically, there was also a parallel process happening. Documentation was being prepared with precision, because later in the transaction, those documents would determine whether payment would be released. Eventually, everything came together. The rugs were finished, inspected, packed, and transported to the port. At that moment, the transaction moved into its most critical phase: shipment. Once the rugs arrived at the port in India, the transaction entered a very different phase. Up to this point, everything had been controlled. Production was controlled. Financing was structured. But once goods enter international transit, control begins to disappear, and risk increases. That's why before anything was loaded onto a vessel, we had to address one very important question. What happens if something goes wrong during shipment? Because a lot can go wrong. Goods can be damaged, containers can be mishandled, shipments can be delayed, and in rare cases, cargo can even be lost at sea. So we arranged marine cargo insurance. The insurance policy covered the value of the goods during transit. Now, at the port, another set of players became involved: port authorities, customs officials, inspection agencies. The goods could not simply be loaded onto a ship. They had to be cleared for export. That meant verifying what the goods are, where they are going, whether all documentation is accurate and compliant. And this is where precision becomes critical. Because remember, the letter of credit requires specific documents, and those documents must match exactly. Once cleared, the rugs were loaded into a shipping container. The container was sealed, and then it was loaded onto the vessel. At that moment, something very important happened. The goods officially left the exporter's control, and this triggers a key milestone in trade finance. Because shipment is not just a physical event, it is a financial event. Once the goods are shipped, the exporter now has the ability to present documents and request payment. After the vessel departed, Rajiv gathered a specific set of documents required under the letter of credit. These included the bill of lading, the commercial invoice, the packing list, the insurance certificate. Each of these documents served a purpose. The bill of lading proved that the goods had been shipped and handed over to the carrier. The commercial invoice detailed the value and description of the goods. The packing list provided a breakdown of how the goods were organized, and the insurance certificate confirmed that the shipment was covered during transit. Now here's the critical part. These documents were not just informational, they were contractual. Rajiv submitted these documents to his bank in India. His bank reviewed them carefully. They checked for consistency. They verified compliance with the LC terms. If there had been discrepancies, they might have rejected the documents or asked for corrections. But in this case, everything was in order. So his bank forwarded the documents to my bank in New York. Now my bank conducted its own review, and once they confirmed that everything matched, payment was released. Because this was an at-site letter of credit, Rajiv received payment immediately, not after delivery, not after I sold the rugs, immediately. And this is a powerful concept. The exporter gets paid based on documents proving shipment, not based on final sale or consumption. So at this point in the transaction, Rajiv had been paid, the banks had fulfilled their roles, and the goods were somewhere in the middle of the ocean, on their way to the United States. But for me, this is where a new challenge began. At this point in the transaction, Rajiv had been paid, and the rugs were on their way across the ocean. But for me, the situation looked very different, because I had just paid for inventory that I had not yet received, and more importantly, that I had not yet sold. This creates what we call a timing gap. Cash goes out today, but cash does not come in until later. And in international trade, that gap can be significant. Weeks for shipping, additional time for customs clearance, more time to distribute and sell the goods. So the question becomes, how does the importer manage that gap? Because if I had to fully pay out of pocket for every shipment, it would limit how much I could grow the business. This is where post-shipment financing comes in. I went back to my bank, and now the conversation was different from the earlier one. Before, they were evaluating whether to issue a letter of credit. Now, they were evaluating whether to provide short-term financing. They looked at several things: my track record, my sales history, the value of the incoming goods, the structure of the transaction, and importantly, the fact that this was a documented, bank-supported trade transaction. So they provided financing. Essentially, they allowed me to cover the payment I had already made, while giving me time to sell the rugs. And this is another key concept. Trade finance is not just about enabling payments between exporter and importer. It is also about managing cash flow on both sides of the transaction. The exporter needed financing before shipment. I needed financing after shipment. And the banking system supported both. So while the rugs were still in transit, the financial side of the transaction continued to operate. The shipment reached the port in New York. And just like in India, port authorities and customs officials became involved again. The goods had to be cleared for import. Documentation was reviewed, duties and regulations were applied. Everything had to match what had already been submitted through the banking system. Once the rugs cleared customs, the logistics company took over again. They arranged transportation from the port to my warehouse, and for the first time in this entire process, I could physically see the goods. From there, the business side continued. I distributed the rugs to retailers. Interior designers began placing orders. Customers started buying, and gradually, cash started coming back in. With those proceeds, I repaid the financing provided by my bank. And just like that, the transaction was complete. A coordinated process involving multiple institutions. Each one played a specific role. Each one reduced a specific risk. They made something possible that otherwise would not happen. Because without trade finance, I would not risk paying upfront, and Rajiv would not risk shipping without payment. So the transaction would simply never occur. And that's the foundation of international trade finance. It does not eliminate risk, it manages it. And in doing so, it allows global trade to function. For me, this was just one shipment of rugs. But the same structure supports millions of transactions every day around the world. And that is what makes international business possible. Thank you for spending this time with me. I'll see you in the next lecture.